Hi, Dom. Welcome to our weekly video, and thank you very much for joining us. It's clearly been a very as we sort of warned last week. I mean, there was a lot of market moves. It's a very interesting week to be sort of watching markets, but there wasn't a lot of data this week just been to sort of change the mood really. And yet we have seen some of that kind of market move reverse quite a bit now. What are your talks? What are your sort of takes on the on the week just gone then?
So for me, from a purely economics perspective, not much change. Most important data was jobless claims, which is kind of consolidating as I expected. But for the markets, I think, there was in my view, an overreaction to the triggering of Sam's rule. Claudia Sam herself wrote a Substack to tell people not to take it too literally, and that she doesn't think we are in recession. And to quote Chair Powell, it's a statistical regularity more than a predictive rule. But so there was, this huge reaction because the triggering of the Sam's rule happened at the same time as, we had this dollar-yen move, people starting to have doubts about the lofty AI valuations. So that spooked people, and then this week we got data that smoothed the market's frayed nerves, even though if they were not, that important from a purely economic perspective. So the services PMI was a bit higher than expected and above 50. You know what I think about the PMI? If you look at the correlation with GDP, it's much weaker than it used to be, but it's still on the Bloomberg calendar. People trade on it, so there we go. A good PMI or relatively okay PMI helped to calm the market. And then we had this weekly claims data that apparently markets liked a lot as well. I find this a bit frustrating because this is fairly low quality data. It's a coincident indicator of the business cycle rather than a leading indicator, but here we are. Initial jobless claim were 7,000 less than market expected, and somehow this was good enough to reassure people. So cool. None of the data of the past week changed my core view, which is, that we are still in an expansion phase. I'm not seeing signs of recession. I have more doubts on inflation, which brings us to next week's data. We have the CPI. The consensus forecast is 0.2% for core month on month, which really doesn't tell us anything, because what's important in that release is the details. So first of all, whether the slowdown in OER inflation we had last month, whether it will continue. So that's some key information for the Fed. And then, of course, the Fed is targeting PC rather than CPI, and those have been quite decoupled lately. So we'll get the PPI before the CPI, actually. I think the CPI is on Wednesday, PPI is on Tuesday, and the combination of the two will give us a sense of where core PC is. From the Fed perspective, I think the key is whether we see an overall slowdown, as I expect. So core PC around 20 basis point month on month actually could be good enough for them to cut 50. And let me explain why it's not consensus. But so if you look at the data, growth indicators are doing okay. But what I think changed and why I changed my call for a Fed cut from November to September is I think we get signs that the economy is not as resilient as I thought. And that sign was really in the NFP, where you could see a hit from the weather. There was a big increase in a category called at work, not at work, for weather-related reason. And those people are counted as employed in the survey. But the increase in that number showed that the weather had a physical, a real impact on work during the survey period. And there was another data indicator that to me signaled the economy's resiliency is starting to get weaker, and that is called workers on temporary layoff. And those are not counted as employed, and in my view, explain why we had this increase in employment and decrease in employment growth. This temporary layoff is starting to get more correlated with people not at work for weather-related reasons. And I think it's a sign of weaker economic resiliency, because when you think about it, if you are a business and you are hit because of, say, a hurricane, and by the way, a hurricane is a perfect macroeconomic shock because it is totally exogenous. You have two possible reactions. You tell people to stay home, and you keep paying them, in which case they are counted in the survey as employed under the category not at work for weather reason. Or if you can't afford to do that, you put them on temporary layoff. You say, I can't pay you, but come back next week. I'll be up and running. I'll have cash flow. I will be able to pay you. And obviously, you do the second thing rather than the first one if your balance sheet is weaker, or if your access to credit is a bit more difficult, or a combination of both. And what the data shows is increasing correlation of temporary layoff with not at work for weather-related reason, which to me says that some businesses out there, likely SMEs, are starting to have lower resiliency, not able to weather shock as well as, say, a year ago. And you see that in the survey data. You see it with more small businesses reporting tighter access to credit. So to me, it's a sign that Fed tightening has started to impact not growth itself, but resiliency to macroeconomic shock. And to me, it's a good enough reason to cut. And my base case is 25 basis points in September. But if inflation behaves as well as the Fed expects, I think it would make sense to cut 50. So this is a long-winded explanation, but
no, it's interesting because in terms of it would make when you say it would make sense for the Fed, do you then mean that just in terms of see the slowdown in inflation, or is it?
In terms of insurance, of basically, so how does monetary policy get transmitted? Not through interest rate payment, because someone's payment are somebody else's interest rate income, right? So it gets translated basically through hits to balance sheet, because say the value of assets falls by more than the value of liabilities. I mean, that's certainly what we saw with the banks and their holdings of long-dated bonds last year. Tighter access to credit, which is what we see in the bank surveys. So in a way, an insurance cut is when you try to reinforce the economy ability to deal with shocks rather than try to address the demand weakness per se. And so if you have the capacity in terms of inflation progress and in terms of your confidence in inflation, why not give as much support to the economy as you can? So that's a rationale for my 50 if inflation is good enough.
And in terms of, I mean, we won't have another NFP before the Fed meeting, but if there is a chance that we get some of that weather-related effect does fade in the following print, or even there is a revision that are sort of more positive, where do you think that leaves the Fed for November, December? You know, we're looking out a
So,
bit further, but just on the topic.
so I think especially if they go 50, unless you see more signs of economic weakness, which is not at all my base case. And by the way, I'm not saying that recessions do not exist. A recession will come. I just don't see signs of it happening now. But if the economy continues to do well, if you've done your 25 or 50 basis point insurance cut, you just, sit down and watch the consequences.
Yeah,
So in my view, if there is no sign of weakness, the Fed should stop at the 15 September and just see how the economy does, and also look at the results of the elections. I've changed my view on the political risk of a September cut outweighing the economic benefit. And I've changed my view because the NFP really showed this loss of resiliency because of Chair Powell's protest. Maybe I'm too much of a believer there, but also because the risk of a Trump win are not as strong as they were before Harris entered the race.
yeah, absolutely. And so I suppose it's the one thing that has been I've sort of heard quite a bit of from a number of sort of watchers is this idea that if the Fed loosens or if monetary policy loosens or financial conditions loosen more broadly, you could see that sort of the demand side come back up again strongly. Do you see that as a risk, or are you more in the camp that we're now sort of in, I guess, soft landing zone?
The Fed is telling us that the risk to its mandate are balanced. That was in the statement. So will cuts, have such a strong short-term effect that suddenly the labor market will no longer be in balance between now and the end of the year? I don't think so. I could be wrong as always, but I think it's more of a medium term, and then we will have a lot of other factors impacting the labor market. So given where we are and what the Fed thinks of where we are, which is, 2019, the labor market is strong but not overheating. I don't think it's a big issue.
Cheers for that. No, thank you very much. And in terms of other things on the agenda this week, besides this coming week, should I say, besides CPI, is there anything else that sort of will be important to watch?
So we have retail sales. I think the consensus is quite modest because we had a bumper number in June. I mean, consumption is doing well. The data is the data. I think this is a reasonable number, so I don't expect a negative surprise. I think the consensus for retail sales ex auto is 0.1% against 0.4% last month. The number I tend to focus on is the control group, because that's what is used in the GDP number to build the consumption estimate. It's 0.1% against 0.9%. It all sounds reasonable to me. I don't expect a big negative surprise there.
Okay, no, thanks for that. Yeah, and then I mean, I suppose for our listeners, there's also stuff going on in Europe. So
Sure. So what is going on in your neck of the wood?
no, sure thing. I mean, so we've got so UK labor market and inflation data right now, and then also we've got some European GDP and employment data as well for Q2, just sort of preliminary numbers. I mean, from my perspective, I think the labor market and the inflation data could be really interesting. Rationale for that is Bank of England did cut at the last meeting, but they did so in an incredibly, well, I would say an incredibly strange way, but I think nothing that the Bank of England does has been particularly normal of late, you could argue. But in short, they came out relatively hawkish in the comments and said sort of there's risks to the upside, which is to be expected. They had quite a close voter balance. So it was 5-4 in favor of cutting, which is kind of wasn't that surprising, to be honest, given how hawkish some of the speakers had been. But then they also revised much higher a lot of their forecasts, especially in the near term. So they're now looking at a much, if anything, more hawkish or more kind of bullish inflation outlook, but cut at the same time. So to me, that I mean, whilst it comes across as a very hawkish cut, I think it also lowers the bar, I suppose, for them being for the data to undershoot their expectations, and therefore could end up being sort of more dovish if they are comfortable to cut whilst revising higher inflation expectations. I mean, on the labor market, sorry.
Yeah, can I ask? This is very interesting because the Fed has been lowering the bar on core PCE as well. And that's because they saw a lot of positive supply shocks or supply surprises coming with supply chains, but also labor markets, increase in immigration, in participation. And so they lowered the bar on inflation to make sure that they didn't kill growth, since a lot of the increase in growth was coming from the supply side. Is there something similar going on in the UK?
I mean, there's definitely, I would say, on the supply side, we have been seeing more loosening, but I think the Bank of England is more probably concerned really on that side than, for example, it sounds like the Fed would be, just because one, the labor market data is not very good. I say that as in the quality of the data is not very good. So there's a lot of uncertainty as to what unemployment really is, what unemployment rate is really, and they've just delayed when they're going to release that. So I think it's coming. The ONS is going to do it next year now, rather than it was going to be from next month. So I think that's one thing that's got a lot of them a bit concerned. But in short, I mean, there are a few sort of index linked sort of structural changes that are taking place in July. So we've got things like energy prices will be coming in, and there's quite a bit of base effect. But in short, I mean, it's quite hard to see exactly why they've become more. They've gone for a higher sort of profile in the near term on some things like headline and core. I mean, services has overshot, so it's understandable why they've done that. But at the same time, and this is one of the things that I'm kind of watching closely, is we've had so the June inflation data showed a big uptick in sort of hotel prices, which we'd kind of sort of been we'd estimated would happen. And I think part of it is down to the Taylor Swift price effect, kind of accommodation prices, which has always been. But I mean, the issue is it's quite hard to see exactly where it has come in, because when you go down to the real metadata of the sort of, I think it's 27 or something hotels that they kind of profiled for that month, it's not entirely clear that it was all in those regions. There were some very large, sort of 100% month-on-month rises in some of the regions, but it doesn't. It's hard to see exactly what the effect would be. So we've kind of penciled in a modest kind of pare back of some of the June rise. But if we were to see that, it would be a real undershoot of versus Bank of England expectations. And even with the market, which I don't think is really pricing in, putting in much in terms of a pair back on that front, even they're looking for an undershoot versus Bank of England expectations. So it's quite strange that the first month out of the gate, I suppose, for these new forecasts, could very well see them already looking a bit overly hawkish. And again, for the same for unemployment. So the market's looking for an unemployment rate to tick up a little bit. To be honest, I mean, as I say, it's not great quality data. I don't put too much precedent on it, and ultimately it gets knocked around a lot by the participation rate. But it would, again, if you start to see the actual unemployment number rise, then it would still be suggestive of the Bank of England being a bit too hawkish in their estimates, and probably potentially the need for them to cut rates more than they're currently sort of they're assuming, basically. So potentially it could open up a September cut if it was to be really come out on the dovish side. But for now, I think the market's not too far from the mark in terms of pricing. I think we've got another 2 cuts price for the rest of the year, which seems relatively reasonable. But obviously a chunk of that has been just driven by the US pricing. So all the volatility from last week. So, I mean, in short, we could see a bit of volatility in UK assets if they do come out on the more dovish side. Yeah, so that's kind of where we're watching right now. So it could be quite interesting. On the European side, so the Eurozone, we don't have a huge amount of data. We do get preliminary Q2 GDP and employment, and the expectations for GDP is basically continue relatively okay growth. Nothing sort of spectacular, but nothing kind of too terrible. I would sort of caveat that you always need to strip Ireland out of any kind of Eurozone numbers, just because otherwise it knocks the numbers around a lot. But the case there is quite different, because unlike in the US, UK, Europe really hasn't seen a rise in unemployment. There's still sort of, it remains very, very tight, the labour market, nowhere near to sort of trigger anything like a SARM rule. But the market has priced a lot of cuts to the end of the year, so very much a cut every meeting. I think that is something that is kind of, looks like it's gone too far, looks a little bit at odds with the fundamentals. So when things kind of normalize a little bit, that could be sort of an attractive place to sort of play it.
Cool. Yeah, a cut every meeting doesn't sound very much in line with the ECB
No.
bent to be, one of the more hawkish central banks ever.
No, absolutely not. Yeah, the Germans are still very much in charge on that front. But, is there anything sort of else, or else I'll run on to some of the pieces that we've put out this week, doing a couple of your own.
Yeah, on my side, that's about it.
Awesome. So, I mean, just for our listeners, watchers, I mean, obviously there's been an interesting week in terms of market moves. Put out a lot of pieces. Bilal's been sort of super busy putting out pieces on 5 things to know about the sell-off, how sort of where the meltdown's really been in equity sectors, and why, or at least at this stage, credit markets are still not panicking. What we've learned from FX positioning, about investor FX positioning post sort of the move, and also a little bit more information, as kind of you've mentioned or alluded to, is why the SARM rule is kind of more of an indicator as opposed to a rule, and why maybe we kind of need to look for more evidence before we sort of jump on. And he does link to also to podcast where he interviewed Claudia Sam as well. And then
Very
Dom,
cool podcast.
no, I would
Strongly
recommend it as well.
recommend it.
Absolutely. A lot of insights into the Fed as well, in general. And yeah, and then also you've put a piece out on has the Fed over tightened, which is a really good read. I definitely sort of recommend to our listeners.
Well, I try to look at this issue of economic resiliency and how you define it and measure it. And I mean, the idea is that recessions are super hard to predict, right? I keep telling people, look at the data, it looks fine, but then, typically there are surprises, because if we expected them, people would change their behavior and then the recession would not happen. So I was trying to think of a measure of Fed tightness based on the economic capacity to resist negative surprises. So that was the point of the note.
Yeah, thanks for that. So yeah, please, if you've got any questions for anyone of our listeners, please do get in touch. If you're a professional, please do sort of get in touch about our professional product. Otherwise, have a great weekend, Dom, and speak with you very soon.
Likewise, I hope the listeners get a chance to enjoy the summer and get a breather after this really bumpy week we've just had.
Absolutely, and us too as well.
For sure.